Well, let's stay on the market. Bring in Unlimited CEO and CIO Bob Elliott, the gold bug I mentioned before. But let's start with the Fed and what's going on there. You think Powell's caving?
Well, I think basically when you look at the change in his statement at Jackson Hole versus where he was just a few weeks before in the presser, it seems like there was a pretty material shift in the positioning, particularly getting to a focus on the labor market. I mean, I don't know how many times in the last presser he basically said the labor market's strong, it's tight, there's nothing to be concerned about, and then all of a sudden he changes his mind.
But we got those jobs numbers right after that, didn't we? And those revisions too?
Yeah, I mean, those job numbers, I think most people who follow the jobs numbers would have expected some revisions that are not that far off of what happened. And remember, the Fed traditionally focuses on labor market tightness, meaning the unemployment rate, and that's remained relatively stable because of the, how did he describe it, the curious slowdown in labor supply at the same time that there's been a slowdown in labor demand. And so if the Fed was really focused on its traditional mandate, the unemployment rate, there wouldn't be much to do here. I think the main thing that is a notable shift in the reaction function is focusing on the overall growth rate in jobs rather than focusing on tightness.
So what's the impact on equity investors then, and how much is riding on that next jobs number due a week from today?
Well, I think for most equity investors that are really hoping for these cuts to come, the type of numbers that are going to deliver the Fed cuts are probably not the type of numbers that they're going to be happy with from a growth perspective. Look, if we start to get, very low or even negative prints in jobs, which is what Waller suggested earlier this week, looking at some timely numbers, that's a pretty bad environment for equities, particularly as they continue to press near all-time highs. And so I think that's the basic tension that exists here, which is that the cuts may come, and that may be good for the economy over a longer time frame, but it may not be good enough, fast enough for the equity market that's expecting strong growth ahead.
What did you think of these inflation numbers?
Well, I mean, who cares about inflation anymore? The only thing that matters is jobs, right? I mean, I think that's basically what Powell said in the Jackson Hole speech, which was essentially no matter what the inflation numbers are, at least for the next year, while tariffs are on the table, they're looking through those numbers.
Well, that's what Powell said, but look at Caterpillar, look what Gap is saying about the impact of tariffs on pricing and on their profits. What should investors take away from that about what to expect out of these companies and out of the economies in the quarters to come?
Well, I think the main concern for equity market investors is that rising inflationary pressure as the tariffs sort of, are going through the python out the end to face consumer prices, to raise consumer prices, is that unless consumers are increasing their incomes, which, with a weak labor market, they're probably not, that basically has to come, that higher prices has to come out of real spending. And so we've seen a pretty weak consumer. I agree today's data was marginally positive, but if you look over the course of the first half of the year, consumers were already spending on a real basis about half the pace that they were in the previous 2 years. And so if inflation passes through, we see prices rise and consumers don't have more to spend, that's probably going to hit real consumption. And real consumption really is the backbone of the whole economy. There's only so much this economy can do without the, consumers consuming.
Curious what we get in Q4 then, the holiday season. We'll talk about gold, if you will. What's the function in your portfolio? Does it change at all under these conditions?
Well, I think gold's really proving out that of all the assets that you can hold to protect yourself against, let's say, interference in the Federal Reserve and the devaluation of the dollar, that's inconsistent, let's say, with overall economic conditions. Gold's the only asset here. You look at the board today and you basically say, gold is proving itself as a contra-currency as concerns about the Fed rise, and things like cryptocurrencies, which are claimed to be digital gold, are pretty clearly showing themselves as risk assets. To be clear, as they have time and time again. There's only one gold, and that's the yellow metal.
All right.